Good afternoon. It is Thursday, February 5th. We are still the Ways and Means Committee. It is 1:17 p.m. And we are taking more testimony on federal conformity and our link up with the federal tax code, specifically in the context of corporate and business taxes. I'm going to really encourage members of the committee and witnesses to use some discipline with language and not confuse businesses and corporations as interchangeable words because they have very different tax statuses. And so I might, if it starts to get confusing, try to interrupt and check in again. And I think with that, Amy, would you like to join us?
I would, and Mike,
Thanks so much.
Sit up there with me.
Great.
So we're gonna just stream one right into the other. Keep it.
Love it.
Great. I will jump right in. My name is Amy Spear, and I serve as the president of the Vermont Chamber of Commerce. Thank you for having us in today to talk about this. My testimony will be very brief, and we'll talk more about the business context. I'm joined by Mike Hackett, who will be our subject matter expert. So please have lots of questions ready for him. So, one thing that we want to set the stage with is federal conformity, I know, is in this room often treated like a technical exercise because it really is from a policy perspective. But for Vermont employers, it has a lot of real impact. So we wanted to take a deeper dive on that today. So right now, businesses across the state, not a surprise to anybody in this room, are really navigating real and immediate disruption that's driven by federal actions that are beyond their control. So tariffs, trade uncertainty, shifting in federal policy, they're all affecting their supply chains, input costs, margins, and long-term planning. And I think it's important to emphasize that Vermont did not create these pressures, but at this moment in time, Vermont can decide whether to compound them or cushion them. So our business community is very diverse. We have manufacturers, healthcare providers, hospitality operators, retailers, farmers, professional services firms, and globally connected companies. All feel these impacts differently. And I think it's important to note that they are all feeling these impacts. And at the same time, they operate under different tax structures, but they do share one reality. And that is that state decisions that are made matter more when the federal policy is unstable. So when we're seeing instability at the federal level, stability provided by the state is very important. So I do also want to emphasize that in moments like this that we're sitting in this room right now, conformity is, to a certain extent, it's really not about supporting federal policy, but it's about supporting Vermonters in spite of federal uncertainty. So from the Chamber's perspective, the most important conformity decisions are those that provide stability, breathing room, particularly around research and experimental expenditures, business interest deductions, expensing of depreciable business assets. And that's because these provisions really help businesses reinvest, modernize, and plan with confidence at a time when external forces are already disrupting their operations. So this is an opportunity for, Vermont to act deliberately on behalf of its employers. Conforming to these key provisions, which Mike will talk more about when he gets underway, I want to be clear that they allow Vermont to offset their impact that's happening at the federal level and reduce friction that businesses are experiencing and help them stay focused on investing in people, equipment, and communities here at home. So, the lens that we would ask this committee to consider when you're looking at all of these conforming changes is, does this decision help Vermont businesses absorb uncertainty rather than amplify it? Does it support investment and resilience? Does nonconformity add cost without improving outcomes? So we know that we're in a volatile environment, and clarity and predictability are really powerful tools in policy choices that can be made now. So we really appreciate this committee's leadership and the opportunity to weigh in on this discussion. I know you spent a lot of time talking about federal changes thus far, and There's many of them and they're complex, so it's why I'm really glad to be joined by a subject matter expert that can field your questions and hopefully provide some additional context beyond the level setting that I just said today about the business environment. So with that, yes.
I have a question for you before you, yes, and maybe other people do, I'm not sure.
Yeah.
Have you been able to figure out
My
who
homework.
the people are?
So I do have some context.
Okay, that would be really helpful.
And I guess it's not going to be the answer that you want.
That's fine.
So I'm going to forewarn that. So the data gap is real.
Yeah.
There, for sure. So we don't collect that information from our members. And
I don't know if I finished my question, so I don't know if anyone
Okay, go
knows
ahead.
what we're talking about.
Oh, yeah.
So, wanted to know, based on the chamber's membership, how many of the chamber's membership are corporation, like what their tax status is basically, so that as we're having these conversations, like even Amy has a sense of who she's representing in this context. Yeah.
So there's a data gap because we don't collect that from our members. And there's no publicly available information on who is whom in that context. I can tell you that when we're talking about our members and I would say who they employ, I can tell you that our membership represents over 75,000 employees in the state of Vermont. If that is helpful context.
That's good to know, I guess.
So it's good to know. So I wish I had more clarity around that answer, but there really is a data gap there, but maybe tax can provide some additional.
Okay. And that might be a fun thing to figure out in future years. Cool, thanks. Anyone else have a question for Amy?
Okay. I think I'm gonna share my screen here. I'm not a tech expert.
And yet you were able to, there you go.
There you go. See if I can get rid of this now. Okay. There we go.
More of an expert than you realized.
Wow. I think I'll have mistakes on the technical side. All right, so thanks for having me. My name is Mike Hackett. I'm a tax partner and leader of our tax group up at Gallagher Flynn. And put together some slides to sort of kick off the conversation, maybe level set, go through some particulars, a little bit of nitty gritty tax and accounting in there. So apologies, but I feel like it's important to set the table. And my goal is that once I do that, please stop me along the way if you have questions. It's probably easiest as we go topic by topic, but then when I'm done with that, it's surely not going to take a whole lot of time. And I'd love to just answer questions and be a resource for anything that you've all talked about or batted around and want to bounce off of me. So I want to be clear about, there's a lot of tax provisions in HR 1 that Vermont could conform or not to. And I'm trying to just declutter the field a little bit and take a few things off the table to focus in on what I think it's worthwhile talking about. There's a lot of talk about personal tax. Personal income tax changes that were part of HR 1. So this was, the headline ones are no tax on tips for certain taxpayers, no tax on overtime for certain taxpayers, auto interest deduction, and an enhanced senior deduction. From a CPA's perspective, these are somewhat irrelevant for Vermont taxes as they don't track to the way that we compute Vermont personal income tax. So in my view, these are not worthwhile discussion topics, and I just wanted to set the table and complete the picture. And Emily, I guess I wrote something in here that is along the lines of what you were saying, so I'm glad I did, just to be clear about what we're talking about in the types of business tax. So switching over to business income tax, the areas I'm going to talk about apply to all entity types. So if you're a sole proprietor, if you're an LLC, if you're a partnership, an S corporation, a C corporation, all these provisions apply to those taxpayers. I'll go through each one of these in a little bit of detail, but I kind of pulled these out as the major headline items that are worthwhile talking about. And again, in the interest of sort of clearing the field, I wrote at the bottom of this slide, bonus depreciation. is something that I don't think the state, I can't say ever, because I haven't been here forever, but I can't say that I'm pretty sure in the last 20 to 30 years has never conformed, so it's probably not worth talking about. And many states do not conform to bonus depreciation. So we can kind of take that first bullet off the table for productive conversation. So the first change was to section 179, which is the depreciation code section, which allows businesses to deduct up to $1 million. Prior law, before HR1 changed it, was deducting up to $1 million of their capital expenditures, and that phased out at $2.5 million. The new law, which I mean to be HR1, has updated some figures in that. It's expanded it to $2.5 million of the actual expense, and the phase out is now higher at $4 million. So Vermont already conforms to the old law, and the new law simply updates the limits. I think the practical application we would see is a lot of this is keeping up with sort of rising costs of our local business. So decoupling from it would keep the old limitation stale, not really reflect the rising prices. But a wrinkle here, just from a practitioner standpoint, it causes additional costs and compliance for now having to track multiple sets of laws for the same taxpayer. Anytime we can follow the federal rules, I don't mean to paint us CPAs as lazy, but we do pass on our costs to our clients. And if we're going to spend more time now tracking a whole different set of rules for just state purposes, we've now doubled the work in that area. So I say that a few times throughout this. I don't mean to do it to hammer home the point, but just point out that these are real costs for taxpayers. When we decouple, we now create two systems that are running parallel.
I guess a question that's going to keep coming up in my mind through that, which I don't know if we can answer at this time, is the businesses that accountants are working with in this context, how many states are they filing in already? And so I know that there's, every state has slightly different tax code, and so you're already doing stuff fresh for each state.
Yeah, I would say for us, we're by far the largest, and we still have a large CPA firm. We still have a large contingent that probably only file in Vermont.
Okay.
In front of a room like this, I'd hate to make up a number that's completely false, but it's a meaningful amount. We certainly have many taxpayers that are filing in 45 states. And yes, you're right. Depending on how many states, that does add quite a bit of complexity. For all other CPA firms in the state, that percentage of Vermont only businesses probably grows, so that this would probably hit smaller CPA firms and smaller clientele a lot harder than it would for us. So that's section 179, depreciation. Obviously this hits, it's industry agnostic. This hits any business, but we see this mostly in manufacturing, construction, software with infrastructure, a lot of key Vermont industries. The next one is section 163J. This is interest deduction limitation. And the old law was in effect from 22 to 24, so it wasn't that old, but it essentially limits a business's ability to deduct interest expense if they don't have enough EBIT. So a business that is certainly losing money on that basis is not going to be able to deduct their interest expense. They're going to have to carry it forward. And there are other permutations that it could be. I don't need to go through all of them. And essentially, the new version of that under HR1 is changing it to an EBITDA basis, which is adding depreciation and amortization, which is the way it was prior to 2022. Obviously, for capital-intensive businesses, EBITDA is much higher than EBIT. And so businesses that are borrowing to fund expansions, new workforce initiatives, et cetera, are under the current, under the old law, are able to deduct less interest expense. So it's raising their taxable income. Again, I think Vermont's always conformed to this. This law was new in the 2017 TCJA. Prior to 2017, 163J was a different provision entirely. So since 2017, Vermont has conformed. And decoupling would be a first in that, and then it would limit that business's ability to deduct that interest even more, and then cause another department for us to track in parallel. This one, sorry, go ahead.
No, you finish your sentence.
I was just gonna say, this one hits a lot of industries, anyone borrowing. Particularly though, this hits the real estate industry pretty heavily, as it's a high finance industry to begin with, and the complexities arising from this and how people build and develop real estate products in the state hinge a lot on how these calculations pan out from a cash flow perspective.
Representative Brannigan?
Can you help me understand the lingo, EBIT, EBITDA, and tell me more about 163J? You gave me a clue, real estate, okay. But I don't know what else you're talking about.
Yeah, so when let's start with, so when a business borrows money and has incurs interest expense, normally that's a deductible expense against their income because they're paying their lender. If under this rule, there are limitations of how much you could deduct. So right now, the rule is earnings before interest and taxes. The 163J limitation says that's EBIT. Yep. Sorry, I should have a warning on the presentation about the accounting and tax lingo.
Okay.
That number is multiplied by 30%. And that provides the ceiling for how much interest you can deduct. So if you're a wildly profitable business, that ceiling doesn't mean anything for you. You can borrow money and you can deduct your interest expense. If you're a business that's struggling, not doing well, producing a loss, and you go to borrow money, you're going to be limited by this provision to be able to deduct your interest expense. You don't lose it forever. You get to carry it forward for a day when you do have income to offset against. But as you can imagine, there's a lot of different outcomes that come from that, and it produces sort of odd results along the way. So
How is that good for government? So I'm assuming this came from Washington, right? Why do they want to?
this came about in 2017, TCJA. It is a revenue raiser on its face
Oh,
because it limits some people deducting interest. So in theory, it's raising taxable income a bit.
okay.
How it's been calculated has bounced around a bit since 2017. And it's now at its least taxpayer favorable peak in EBIT. So under HR 1, it ratcheted down just a little bit to become less unfavorable, I guess I'll say. Does that make sense?
Yes.
Okay.
Yeah, that helps. So 2017, you said, so the CPAs in our world already know about this? Okay, good.
Yeah, yes, the law generally, and then it's moved a little bit throughout the years. Many things in TCJA had varying expirations and varying thresholds. And so now, under what I'll call old law, Vermont's conformed to this every step of the way. And then HR 1 made a change to it that I suspect CPAs are expecting would conform again, because that's what Vermont's done since 2017.
Okay, thank you.
That helps. Okay.
Yes, very much. Thanks.
Any other?
Not yet.
Not going to spend a lot of time on the foreign tax revisions. Truly, I'm trying to be practical about this. I put some things in here just to give context and have it in writing, and anyone could go back to it if they wanted to read it. But essentially, HR 1 is tweaking these provisions in disparate ways. Some are favorable, taxpayer favorable, some are taxpayer unfavorable. And depending on the facts and circumstances, it's really difficult to say which way they actually go. Vermont already conforms in these areas. So I added at end, decoupling adds significant complexity. This is already a highly complex area of tax. To be fair, tacking back to a question you asked earlier, because of our size, we deal a good amount with this. We still sometimes have to reach out to other experts nationally on these topics. Less likely to hit smaller firms and smaller taxpayers in Vermont, but for the ones that are already in it, decoupling would create more complexity with very unclear results of which way it would actually send their tax or benefit under these, just because of how disparate the changes are.
And what types of businesses are eligible for this provision?
So I actually packed a lot on this slide. GILTI is a punitive provision. GILTI is a tax provision. If you fall into it, you pay extra tax. All taxpayers are subject to that. FDII is a tax benefit. It's an enhanced deduction if you do certain things. That is only available to C corporations. So I breezed through a lot, but
We've spent a lot of time with JFO on our joint fiscal office on this over
Okay.
the years. And one of the things that's sort of interesting about it is when they have been able to come to numbers on it, it's often very different in from what other states' numbers turn out to be, just because of the particular composition of our tax filers here.
I'm not surprised because it's just wildly complex.
Yeah.
It'd be hard for me to even make a guess at how it scattershot affects our business climate. It adds a lot of complexity, but to the actual tax bill, I'm not quite sure. So I saved what I think is the best for last. And certainly the most, I guess, jarring change under tacking back to that 2017 TCJA tax law that happened at the federal level. Section 174, research and development, or R&D expense capitalization, was a completely new element brought along with the TCJA in 2017. It was a revenue raiser back then because it mandated that businesses no longer could deduct their research and development costs in the current year. They had to capitalize it as if it were a fixed asset and amortize it or depreciate it over a period of many years, over 5 years for domestic, 15 years for foreign R&D. So I can say that our client base in particular has struggled quite a bit with this provision, complying with it and the tax impact of it along the way. And we've seen a lot of real negative consequences of it. HR 1 essentially reverses this section 174 capitalization and says that we're allowed to go back to the rules for federal purposes that allow immediate expensing of R&D expenditure. And when I say R&D expenditures, that's primarily wage costs of people being paid to perform research and development. It can include supplies. You know, when people say R&D, they think of white lab coats and things like that. But in our state, it's actually probably not that. It's more manufacturing based, software based, given our pretty burgeoning scene in that space.
So it could be just the person sitting alone at their computer creating a new intellectual product.
Yeah.
So in the software business that you just said, so if somebody wanted to launch a new version of their software program and they just are investing hundreds of thousands of dollars in payroll, then that's an R&D cost.
Correct.
Right?
Yeah.
Because they can't expense it. If they couldn't do that, then they have to capitalize that expense and amortize it over what,
5 years, correct. Yeah. I have what I hope to be is a really simple example just to show what that looks like before and after, and maybe it makes sense to,
Can you also remind us what types of businesses this, like what business structures this applies to?
all.
Thank you.
Yeah. Good, thanks for clarifying. Including if you're not a registered business, if you're just a sole proprietor, just doing things on your own. Why don't I, nobody likes it at Gallagher Flim and I improvise, but I will. I'll go right to this slide. I just thought it'd be
It
helpful.
might be more flexible than accounting firms, I'm not sure. I'm really not sure, it depends on the day, yeah.
So, hopefully a simple example of what this does to a business's taxable income. Under pre-TCJA, and I mean, let's just pre-section 174. If a business had $1 million of revenue, $700,000 of other expenses, and they spent, to your point, maybe they spent $500,000 of R&D related expenses. And for simplicity's sake, we could just say all these expenses are wages. They're just people performing services. That business intentionally ran a loss. Maybe they're a startup or whatever. They're choosing to invest in their business, so they ran a loss. So in 2021, they would have no tax bill for federal and Vermont purposes because they didn't turn a profit. When Section 174 came into play, let's assume they were the same business and they had the same year, $1 million of revenue, $700,000 of non-R&D expenses. They wouldn't get to deduct that $500,000 of wages they paid out. That would be classified as research and development wages. They would have to amortize it according to that schedule that I put on the bottom of the screen. So in year one, under 174, you get a half year in the first year. So it's 50,000, not 100,000. And so that same business who has the same economic setup now has taxable income of $250,000, and they would pay federal and Vermont tax on that $250,000. Nothing about the business has changed. They've spent all their revenue. They've actually spent more than their revenue, assumedly they either raised equity or borrowed money to spend that extra $200,000 that they didn't get from customers. And so that's kind of the example of how it plays out in 1 year. It obviously gets more complex when you start stacking many of these years on top of each other because they have amortization from old years, they have new capitalization from new investments, and it starts kind of going on and on from there. So what's happening now is for federal purposes, we basically get to, in varying ways, depending on the size business you are, pretend like that rule never existed and unwind it all. That's what HR 1 has done to change. So my second bullet, I think I've sort of covered. We did conform pre-174. We did conform to 174 as it happened. So if we didn't conform, that would be the first time that we're not, as it pertains to this kind of topic. And we've seen it cause significant distortion between kind of an economic reality of a taxpayer and what their tax return winds up looking like and what their tax bill winds up looking like. And we've seen it impact a wide variety of businesses, manufacturing, software. It's hit brewers, many of which we work with, engineering firms. It's hit quite hard. It's surprising to know that much of what engineering firms do, because it's so custom to each project, is actually considered partially research and development. And so some engineering firms have actually been hit quite hard by this and had to go borrow money or find new financing facilities to pay tax bills along the way for some of these things. Same thing with construction, since engineering is oftentimes a component of various construction projects. The one that it's hit hardest for sure in our state and across the country is research grant recipients. So I know I can speak for even me personally. I don't work with every client at Gallagher Flynn, but I personally have a few clients that their business models is formed on them getting various research grants, usually NIH or Department of Defense, and that funds research and development they're doing according to whatever the grant is mandating that they research. And the way they make money on that is by usually getting a cost plus markup. So if the NIH grant is for $1 million and it's a 10% markup, they'll be mandated to spend that $1 million on the research, again, probably hiring people to perform that research. And then the business retains $100,000 as profit, the 10% markup on that. Sometimes they're able to keep the intellectual property, sometimes not. Sometimes they're able to make products based on it, but that's very fact specific. But we have clients that sort of live on that cost plus markup. And so their real profit every year is that 10% in my example. I'm sorry I didn't lay this out in the visual. It probably would have been easier, but hopefully you could follow along. Under these rules, all of the work they do for that research grant is considered R&D. So their taxable income just went from $100,000, which is their true profit, to something far more than that because they can only deduct a fraction of what they spent. The particular challenge for those businesses is that the grant requires them to use every dollar they get for grant purposes. So they can't use grant money to pay their tax bill. So many of our clients that are in that position have to go to the bank and borrow money just to pay their tax bill. And some weren't able to do that. They don't have lendable assets. They are just a service company. They don't have anything they don't have any borrowing power to begin with. And it's put in question whether or not they can be a viable business. So it's been a tough few years for businesses in that sector. Not relevant to taxation, but doubly hard now due to the fact that now they're not getting grants as much. So it's just been a big hit to that corner of the industry, which may not, you know, like I said in the beginning, we think of R&D as white lab coats, and I'm just trying to paint a picture of how it affects sort of our everyday businesses.
If you go back to that example, the $100 million, 100,000. So under the old, they'd have to current tax law, well, old.
Yeah.
Yeah, you'd have to amortize, what, $900,000 of that?
Yeah,
Whereas under the new laws, they can write off the $1 million.
right. And arrive at their kind of true profit, which was the $100,000. Because they've spent all the grant money they've received. Those businesses are supposed to be a conduit for that money. They're not supposed to keep the million. They're supposed to make just the markup on the service they
So
provide.
tax liability goes down significantly if they can write off $900,000.
It matches their kind of like true economic outcome for that year. When we make them capitalize the money they spent, it distorts that picture of their tax return into something that didn't really happen. I guess it could be similar to this example.
Yeah.
It's just much more pronounced in that circumstances because all of their expenses are considered R&D.
Yeah, because I can see the logic for the business. I'm just thinking from a revenue standpoint for the state.
Yeah. Yeah, you're thinking about it correctly. I have one slide left. It's related to 174. I can either hold if anyone has questions or just. This one is I wrestled with how to kind of write about it because it can be a bit of a rabbit hole, but this is a Vermont particular issue that we're walking our clients through the options of what to do now based on just where we are in time with Vermont not conforming and businesses having to take action. So I said earlier, the federal law under HR 1 now is basically pretending like 174 went away completely. And there are multiple avenues to do that. There's a special avenue for small taxpayers. Federal government defines small taxpayers as anyone with 31 million or less in gross receipts. Which is, you know, I would say for us, that's sort of a bread and butter Vermont company. Probably 100 to 200 employees, somewhere in the $15 to $30 million revenue range. So it hits quite a bit of our client base. They were able to amend 2022 to 2024 tax returns for federal purposes to erase that 174 impact and get their tax return back to the way it would have been if that law didn't exist. Since Vermont doesn't conform as of today, they can't do that for Vermont purposes. Which would be okay if there was a different way to do that, but right now there is no way for them to do that. So when they go to file their 2025 Vermont tax return, which we're starting now for them, that tax return starts with a federal number. That assumes that 174 impact has already been accounted for. So as we go through the Vermont tax return, as it stands now, and the department could probably comment on this better, but I think it's our understanding that there is no mechanism in the 2025 Vermont tax return to reflect the fact that that taxpayer needs to be made whole if Vermont was to conform to 174. And so without any legislative action, that taxpayer might lose those deductions for Vermont purposes permanently based on how the forms kind of just talk to each other. Because again, the 2025 tax return is starting with a federal number that assumes you've already taken care of removing this 174 in a prior year, which they're not allowed to do right now.
And we
I
can.
know this is a little tricky, but
No, and we're gonna hear more about this from the tax department. Go ahead,
Okay.
Representative.
Permanently, as in they can't amend. So
right now, yeah,
when would they need this change to be enacted? Before April 15th?
selfishly, as soon as possible.
I'm asking you, April 15th, is that it? Or can they
Yeah.
all just extend their filing if they know something's happening here? Like file later?
That's a possibility, yeah. Yep.
They could amend the return this issue. Could they amend it?
If the law allowed for that, yes.
So we have to say that.
Yeah. Yeah.
But it's not so good because they have to figure out how they're gonna pay their taxes first.
Right, they would have to send in a check to Vermont knowing that hopefully some of it comes back. And sorry, I'm not being cagey with I'm trying to play out all the
You don't seem to.
scenarios in my head to make sure I'm covering all the bases of the scenarios that we.
I'm sure someone might correct you next if they catch something, because we have lots
Yes.
of other professionals coming up.
Please,
So you don't have to be perfect.
I cram a lot.
Yes.
Thank you.
Yeah.
I wish more people would tell me. Yeah,
I'm gonna encourage you to go on to the next slide.
that is it. My next slide is thank you.
Oh, perfect.
So I'm trying to live up, I didn't live up to it too much, but we did have some questions in the meantime. I just wanted to make sure we leave space for.
Thank you. Are there any further questions? And are you able to hang out through the testimony?
Yeah.
Thank you so much. Really appreciate you both.
Thanks for having me.
That's very good.
And is Bruce inside the computer? Yes. Mr. Fort?
Hi, everyone.
Hello.
Thank you so much for inviting me to talk to your committee today. I really appreciate it. First of all, let me start off by saying I am speaking on my own behalf and on behalf of the Multi-State Tax Commission. I have lots of opinions. The Multi-State Tax Commission has fewer, and we don't generally speak through our attorneys. But so anyway, I greatly appreciate the opportunity to speak here today. Really enjoyed Mr. Hackett's presentation. I learned a lot. I am not a CPA, and the devil is in the details, and he did a wonderful job of explaining sort of what goes on. I want to start off by saying that there's a report in state tax notes that corporate income tax revenues at the federal level are down 32% for the second half of 2025. That's a pretty remarkable number, and a fair amount of that are retroactive claims, if you will, for R&D expenses, what you just heard, Section 174. It is a complicated area, but it may be that Vermont is just going to have to say, well, as you do conformity to the next tax year, just be aware of that to the extent you are conforming and including the 174, which I think is the bulk of that reduction, there will be a tax loss. It's not the end of the world. And Mr. Hackett talked about the importance of maintaining some sort of uniformity and maintaining some sort of ability for taxpayers to comply. I totally agree with what he said there. And so when you're balancing whether to conform or not to conform to particular provisions, you have to keep that in mind. I really want to talk today mostly about the foreign international tax aspects that Mr. Hackett touched on very briefly. I don't think he quite presented it the way I would have presented it. So let me try to clarify that. Beginning in 2017, the federal government really enacted a new system for taxing the income of multinational corporations. And they did that through something called GILTI and something called FDII. And GILTI provides basically that global intangible low tax income will be included in the tax base of the domestic U.S. corporations. And then in order to work an effective tax rate, they want to get something close to a proposed minimum 15% tax rate that is going on at the international scene. they did a deduction in section 250 of basically cutting that number in half. So it's kind of an awkward thing. They could have just said, we're going to bring in GILTI at a lower percentage, but instead they brought it in at a higher percentage and then cut it in half through the IRC 250 deduction that Vermont does currently conform to. Now, FDII is a slightly different issue. It is a deduction also in 250, but a separate section, a deduction for income that is earned through foreign sales and sales of property and services to a non-related party internationally. And so that has turned out to be a pretty expensive deduction. Both of them are expensive. GILTI for 2021 was $607 billion out of a total tax base of about $457 billion. So it's a big chunk. I was just on the IRS's website called Office of Statistics, and 96% of companies with over GILTI is paid for by companies with over 2.5 billion in assets. 96% of GILTI comes in through these large multinational corporations. The FDII deductions are, again, two deductions. One is for GILTI, one is for FDII itself, and they total about $400 billion. These are 2021 numbers. That's the newest thing they have on the IRS website. So just wanted to be aware of that. What Vermont currently does is tax 50% of GILTI. You tax the GILTI after that 250 deduction, and then you allow what's called apportionment. You allow the factors of those foreign CFCs, we call them, foreign subsidiaries, into the apportionment formula. That reduces the Vermont taxable percentage, and we think that's very appropriate. We being the MTC, and I think tax nerds like myself generally. The idea is to keep your base as wide as possible and then use the apportionment formula to make sure that Vermont isn't taxing extraterritorial income. What I would propose in my own name and not on behalf of the MTC is that you consider eliminating the IRC 250 deduction entirely and bringing in 100% of, it's now called NCTI. It is no longer called GILTI. It's actually about 10% broader than the old GILTI number. And bringing that in and allowing factor representation, which you already allow for the 50% you do tax, allow that for the entire amount. And we think that, to us, that is a conformity to the federal system to bring in 100% of this income. I describe NCTI as essentially an attribution of income, just like you would have a partnership owned by a corporation. You attribute the income of that partnership to the corporation, and you also bring in the apportionment factors of that partnership into the corporation. So if that partnership is doing business out of state, Vermont taxes a smaller amount. So speaking for myself and not for the MTC, that is the one reform I would suggest that you really look at as something that would actually bring in, increase conformity to the federal system, and basically recognize that we now have a new federal system where this foreign income, is now being attributed to the U.S. company, and we don't want to overtax. We don't want to tax a multinational corporation on its income earned abroad, and use the apportionment formula, the apportionment system, to change that, to reflect that. I have very little to add to what we already heard about the various deductions and how they're going to affect Vermont. I think Mike did an excellent job of setting that out. I really don't have anything to add. I really just wanted to focus on that one issue, which is that you consider including 100% of NCTI, which used to be called GILTI. It is a slightly broader number, that you consider including 100% of it in the tax base, that you consider eliminating the IRC 250 deduction for foreign derived intangible income. And that deduction number is going to be higher now. It's going to be even more generous to taxpayers. it's really a policy decision in terms of, is this encouraging, Vermont manufacturers to export? Is that an appropriate policy choice on your behalf? The states, in terms of conformity generally to the OBBA, the states unfortunately are all over the map. I totally understand the concerns with the concerns with complexity. Unfortunately, it's just going to be a feature of our tax world going forward because states are doing things. Massachusetts, the governor today just proposed a partial conformity that's going to look at 174 and maybe allow a different allowance of depreciation expenses. It's going to be complicated for businesses that do business in Vermont and Massachusetts should that become law. I don't know how much you all can avoid all that, those considerations, but I do know that Vermont, generally speaking, has chosen to conform as best they can with the federal tax code. And I understand that, especially given the number of smaller businesses you have operating in Vermont. And so I understand your concern there. In New Mexico, there's a bill being considered later on this afternoon that will include 100% of GILTI in the tax base, allow full apportionment, decoupled from the 163J extension of the interest expense. And I think I explained it very well. It will affect real estate firms in particular who tend to borrow a lot. So it will decouple from that, what I would call a higher allowance of interest rate expense. It would also decouple from bonus depreciation, but the legislature is not considering any other decoupling, even though there's significant aspects to that. Just wanted you to be aware of that bill. I'll be testifying about that in a few hours. But in general, I don't have much to add to the presentation you just heard. I thought it was excellent. I thought it really laid out your policy choices for you very well. And again, I would urge you, speaking personally, I would urge you to focus on why not include 100% of this NCTI, formerly called GILTI, in the tax base. Use the apportionment formula to make sure Vermont is not overtaxing corporations, and look again at Section 250, the Section 250 deduction for income generated from overseas sales, and see if that's appropriate for Vermont. The Office of Statistical Information at the IRS notes that both FDII and GILTI are basically only affect the very largest corporations doing business in Vermont. It's just not something which your smaller businesses are affected by one way or the other. Again, 96% is paid by companies with at least 2.5 billion in assets, and yes, you will. I think as you conform to the 2025 thing, you will see a reduction in revenue, and I think you have to balance that reduction in revenue versus the added compliance burdens on your smaller and mid-sized businesses. And I thought you heard a pretty good discussion of those pros and cons already. I don't have anything to add to that. So that's my presentation. And I'm happy to answer any questions if you have.
My first question, Bruce, is do you have written testimony that you could send to us?
I'd be happy to put something in writing. I'm happy to do so.
Thank you. I appreciate that very much. You can send it to Sorsha, who's been in touch with you about scheduling.
Okay.
And my second question is, do you have any thoughts on the small business stock offering section? I'm not using the right technical term because I should have scheduled this testimony in the morning, not the afternoon. But qualified small business. Oh, it's close. Okay. Do you have any thoughts on that?
I don't have any thoughts on that. You heard earlier this month from Carl Davis of the Institute for Tax Policy, and his organization wrote a paper saying that small business thing is a it's overly generous. I'll put it that way, but I don't have any thoughts on it. I have not studied the issue.
Okay, thank you.
Charlie Kimball here, wondering, the governor of Massachusetts suggested a decoupling with 174. Did he say why? Was it a revenue question?
I haven't actually studied his. I actually haven't studied his pronouncement. It just came out today, and I can send that to you. It's in state tax notes. I can send it to the committee. But I just wanted you to be aware of that Massachusetts is looking at some decoupling right now. They're going their own way, and whatever you do, I think you have to be aware of what Massachusetts is doing. It may be you want to coordinate with what they're doing in terms of lessening the burden on your own businesses. I know you have a lot of your businesses that operate in Massachusetts operate in Vermont and vice versa. But I will send you the governor's statement.
That'd be great. Thank you.
Any other questions? Thank you so much for your time. Tell New Mexico we said hello.
All right, I
And
will.
keep
Thank
up the
you very
good
much.
work.
All right.
Thank you.
They have a great flag.
We've talked about the flags. This is now the second. The flags that I think is cut off.
Too many.
Too many. Exactly. Rebecca and Will, do you wanna? Oh, I'm sorry, Representative
Do
Bodie.
you think that Michael Hackett could talk about the qualified small business stock?
Would Michael Hackett like to talk about qualified small business stuff? Okay, come on back to the chair.
Encore.
I don't have the safety net of my slideshow, so.
You can sit here at the table if you.
That would be way too scary.
Okay.
If you're feeling far too.
I'm worried about you and Teddy's coffee there, so.
My son's already spilled on these pants once today.
Um,
So what specifically, I don't think you want me rambling on.
Conformity, not conformity. And I was, what I've read so far from ITEP and then I think a treasury report from the spring was that it was just sort of significantly more expensive for the feds in the states than anyone anticipated. That would be the extent of my
You
knowledge.
do see it quite a bit. So is it worthwhile going over the general construct or this is a provision that only applies to investors in C corporations. So all other business types do not produce this benefit for its investors. What it basically says is if you invest money in a business that has less than now $75 million in gross assets at the time that you invest, and you meet other certain requirements, including how long you hold that investment for, which is now I think 5 years with some staggering along the way. If you kind of make it to the end zone, I'll say, after you've covered all those hurdles, upon selling the stock in that business and exiting your equity position, you don't pay tax on that gain. So we see a fair amount. Many, I don't have the statistics, and maybe somebody else would. C corps are not the predominant type of entity in Vermont,
Very much so.
but of the ones that are here, many of them probably do have less than $50 million in gross assets. Many of them have more than that, but I just don't apply.
Do they actually have tax liability?
So this is a liability on the,
Oh, and the individual who owns this,
Yeah.
yeah, sorry.
where you see this most in practical application is startup companies, of which we have a fairly burgeoning scene. And businesses will take a lot of care to become a C that have this vision of growing fast and scaling and getting a lot of investor dollars. They'll take a lot of care to make sure that they set themselves up so that investors can obtain this benefit, because investors will often ask, are you QSBS eligible if I invest my money in your business versus these other businesses I'm looking at. And businesses will, work with us to make sure that, yes, we want to have these benefits so that we can go raise money and fuel our growth. So the fact that the investor pays no tax is sort of irrelevant to the actual business itself, other than the fact it makes it more attractive to get investment. Does that make sense? Is that?
Thank you. So if you had to say, does it kind of help businesses, Vermont startups, is it good for the economy to help startups start up in Vermont? Do you have any pitch for this at all? I mean, it's a big risk, is what I would think, if you're an investor, but I don't know, maybe
Yeah,
there's a company and it's already doing well, and then it has other startups, and this is just really not.
right.
I think of as a startup, what do you think?
Probably broadly, yes, given what I see. We have a pretty healthy
There's a lot of startups.
venture capital sort of micro community here. Certainly probably more than what people who don't live in Vermont would think is here. So, and the amount of conversations and questions that I get from clients and prospective investors about this topic tells me that people pay attention to it and weigh it in their investment criteria. I don't pretend to know exactly what that investment criteria is. I don't make them myself, but it definitely plays a role in that whole kind of scene. People pay attention to it, and it dictates who they invest in, for sure.
Would I be right in thinking if a startup then is doing well, it would be paying other taxes?
Yes,
Vermont?
yes. Yeah,
Do you have any?
some startups, they're all over the map. I mean, some of them are profitable right away and they're just trying to scale and growth, and some are losing money and investing for years and years and years until a big payoff or something big comes down the line. But those businesses employ a lot of people.
Some of them don't, right? There are lots of AI startups that employ very few people.
Yes, I don't know enough to comment on that
Yeah.
side of the business in Vermont, that type of business in Vermont, but what I'm thinking of, there are some tech startups in Vermont, but there's more sort of, interesting consumer products. I think a seventh generation, things like that, that seem a little, that types of businesses that we've worked with through the years that are more focused on that type of stuff. Services and products that kind of reflect the Vermont ethos. Yeah,
Thanks.
that's my opinion.
I appreciate it. Thanks for coming back to the chair. After a quick delay, tax department, you are up.
Sigh of dismay, I heard over.
Not for you. Made the mistake of opening a flood.
For the record, Rebecca Samaroff, Deputy Commissioner of the Tax Department.
And Will Baker, Legal Director at the Tax Department.
And I'm just gonna share a document that should look really familiar because I totally lifted it from Kat. But just to kind of like guide the discussion, once I remember how to share, should be a really big button. Oh, there it is. Oh, no.
Accurate commentary.
Okay, that looks like a thing. All right, so this is just the fiscal impact chart that I believe this committee saw in late January. I conflate the IRC section numbers all the time, so I thought this would be helpful for all of us. And I did actually just have a quote from Governor Healy in my speaking notes for today, and also to correct the record. She described the research and experimentation deduction as tax relief that's particularly important to Massachusetts innovation economy. FYI. So thanks for taking the time to hear from us today. I learned a lot today so far too. So thanks for everyone else that's here. I just wanted to like rewind a little bit and speak to this topic from our seat as tax administrators. Just reminding that like from where we sit, conformity is really strategic. Like it might feel like inaction, especially, when like the policy aims or quality at the national level aren't like really resonating with us, but it's very proactive at our department. It's what our processes are built around. This strategy of conformity and these processes are not set in stone, of course, but they're really doing a lot of work for Vermont coffers every day. And I appreciate the chair's foresight of having Will and I in last week to talk about some of those processes and what our compliance division is up to all the time. It was smart to separate these testimonies. That was really great. It wasn't my idea, but it was the right idea. So just like in the realm of administrative efficiency, I, just want to like say clearly on the record that the easiest path forward for us administratively, and, when I say us administratively, I also mean for taxpayers or, professionals that bridge the gap, is to link up to all federal changes. It's our starting point for income taxes, federal AGI or federal taxable income, depending on if you're doing corporate or personal. So linking up means that taxpayers don't have to navigate additional additions, subtractions, complexity, longer forms when they're filing in Vermont and at the federal level. Everyone has to do both. But there are some exceptions to federal treatment in our law today, and each one really does add a lot of complexity and length to the form. It increases the time, it takes taxpayers to do their taxes. Anecdotally increases frustration with taxpayers doing their taxes, and definitely, adds to complexity on our end, and, kind of like builds on compliance issues that comes from that decoupling. So with that, I'll just take a quick detour to the green box above me, special depreciation for qualified, sorry, should actually look at what
Production property.
Yeah, production property, thanks. I was like, oh, there's peas in there. There is one, this is a new federal provision that actually is very like commingled in statute with the one area that we're already decoupled from, bonus depreciation. We currently decouple from 168K bonus depreciation, and this is the new 168N special depreciation. These are very married in statute. So like, I want the main rub of my testimony to be conform on everything, except because we are already decoupled from this one provision, it makes a lot more administrative sense for us to also decouple from this 168N. If we can talk a little bit more about what these are. I can talk a little bit, Will can talk more if there's follow-up questions, but basically the 168N provision allows businesses to immediately deduct 100% of the cost of new domestic manufacturing facilities, like a factory or something here in the United States. The intention is to encourage folks who do that activity elsewhere to do it on US soil. So the eligibility is pretty tight for this. To be eligible, work on a new production facility has to have begun, or no earlier than January of last year. It has to be completed by the end of 2028 and operational by 2030. So, it's a pretty and targeted piece of the bill, but it is built into the same IRC section as bonus depreciation, just kind of effectively expands what's eligible for immediate depreciation. And which means like for Vermont filers today, in this decoupled section, they just take this tax benefit over time. They don't, take it all in year one. So, our decoupling from bonus depreciation certainly, has add some complexity to our, our forms and our filers' lives. They have to, make a little adjustment every year to kind of true up what they did at the federal level in year one versus like a slower depreciation schedule in Vermont. But at least if we decoupled from this provision as well, all bonus depreciation would be treated the same for these filers. Like, they're used to doing it for bonus depreciation now. We certainly wouldn't want them trying to split these costs that are all grouped on the same line on the federal form into two different depreciation schedules. That would be kind of a worst case scenario, I think, for everyone. So that'll be my one plug for decoupling. It's in the green box. Back on track, conformity for administrative purposes, that's the main rub. So, I mean, I want to acknowledge, of course, that there's other considerations besides administrative ones. And yeah, I guess just really imploring the group as policymakers to, at least balance those with, some of the administrative considerations as well, because on our end, the implementation end there, similarly to the policy end, there's real like equity impacts, there's fairness impacts just based on our ability to like actually do our jobs of administering this fairly. So, that's like kind of the parts of.
Equity impacts to your staff, but equity impacts to taxpayers.
Yeah. Yes, that's what I meant, but I was trying to see if I could spin it a level further, but yeah, no, that is what I mean. And that's because, so many of these provisions, like regardless of their policy merits, they kind of like nibble at the edges of policy that we're already linked up to. So, and that's, part of the reason why JFO and tax analysts, you see many of these numbers are fairly small, it's like small changes to an entity's tax liability across many, many, many tax returns that, will add up to, $1 million or part of $1 million. So just like, thinking about each of one of these individually, the lift of decoupling from these provisions is pretty much like a bear for the department. Especially these ones that just nibble around the edges, like take a policy that already exists and then just changes it a little bit. Because then we would be carrying kind of, a pre-HR1 reality and a post-HR1 reality of a provision. And that's kind of like the difference that taxpayers would be navigating. So like this makes filing correctly, we call it voluntary compliance, which is really like our bread and butter. It makes that really complicated, which it can just be like, because it's confusing, taxpayers think they're doing it right, they're really doing it wrong. It could also be, like voluntary compliance gets a little shady, like over the course of years. This is like so much work. I'm just going to toss in the federal number because I know no one's really going to be able to tell what my real number was. But I worry about it creating like a real tax gap, which one of our goals as an organization is reducing the tax gap. Conformity is like a huge assist in that goal for us. So that's just like in the voluntary compliance space. When you think about the proactive auditing of these deviations from like federal corporate taxable income, for example, it's just like challenging to justify based on ROI, like dedicating staff time to learning about the minutia here and then going to track them down when it's just, like might be like a couple bucks or a couple $100 of a change of taxable income across many, many returns. And it's not something that we can automate in a discrepancy program like the programs we were describing to you last week, because these are not, always clean lines on our federal form that you can, really build into our discovery programs. So there's two examples up behind me that are in red. These are kind of like the two examples of decoupling that would be the worst case scenario for us: the business interest deduction in IRC 163J and the expensing of small business assets, IRC 179. These are, examples of where like the difference between pre and post HR1 are just like very minute differences that aren't captured on federal forms. These would all be challenging, but those two would be like really the most challenging. And just like, I learned a lot from that last testimony and, imagining our staff having to learn IBIT and EBITDA and, like, that's what we're talking about here. That was, I appreciated those questions because that's more complexity than, we have to know for better or worse. We rely on conformity for a lot of these like minutia of tax administration and these, corporate and business income tax spaces. So, yeah.
So your staff know the difference between those two things.
Oh yeah,
Okay.
EBITDA, no problem. No, we really don't.
But when you look at the red, it's, the revenue impact across all filers here is actually, if you consider that's all filers, it's quite small. And so that means we would be looking for differences in the pre-HR1 163J and the HR1 163J, and it would be a little amount for a lot of taxpayers, which for an auditor is the worst place. That's as far as return on investment for our audit programs, that's the worst place to be.
Rather have them working with Bruce Ford on our multi-state audit program through FTC.
Madam Chair, so if we were to decouple from 168N, what would those figures look like? They're going to be in the negative, anymore, correct?
Right. So that would avoid, decoupling on that would avoid a estimated $3.51 million decrease in expected revenue from conformity. So convenient that that one also is like one of the bigger numbers.
That's convenient.
It is.
So just to finish that thought, so it wouldn't like increase our rate, it would just prevent that loss of them.
Mhm. Right. And in like designing the forecast for this year, our state economists were, aware of these conformity impacts, aware that this is going to be an active discussion and, kind of characterize dollar figures to this amount as decimal dust, I think, but, had baked in some dust.
The news.
Yeah.
The international tax provisions. My understanding is every state manages that very, very differently. So I'm conformity, not conformity. We weren't conforming before.
Well, from like a revenue preservation, angle, it's nice that those are revenue ups, I think, the type of further decoupling that Bruce was describing, it'd certainly be a larger, that's something that, I haven't done a lot of research, and I'm not sure, Will, if you can speak to this either, about how, kind of like aggressively that places us in like a national picture in terms of international income taxation. It's something I'd want to learn more about, and certainly not something I've talked to the administration about or anything, but
I've been surprised at the similar advice I've gotten from a really wide range of tax people on that one. Really very different philosophical places in the national scheme have gotten very similar advice. And so that's why I'm sort of curious.
yeah.
Since it went in, this whole scheme went in 2017, Vermont has taxed the guilty, it was called guilty at the time.
Mhm.
And we have been more on the aggressive side, not because of any policy decisions that the legislature made, but just because of our existing law at the time, in existing law in 2017, and then our link up that year. Vermont and New Hampshire were on the more aggressive side just because of our history of taxing foreign dividends and subpart F income, which was another prior iteration of trying to pull some of this income realized in other countries sort of back into the US base. Those were prior kind of attempts at similar thing. There have been other states that have looked at the Section 250 thing, which would be the next sort of, as far as taxation revenue would be the next piece. So we wouldn't be at the forefront. There are other states that are doing the same thing.
That recommendation was 100% of NCTI and then a portion.
You can call it necktie.
Okay, necktie. And a portion, assuming in our previous conversations, it's a portion of the percentage of sales that are actually in. Yeah.
Yeah, so there are two real things that we're talking about here. There's the HR 1 2025 changes, which went from guilty to necktie or necktie. And we said that slightly kind of generally speaking, on average, expanded that income coming into the US shareholder. So that's one thing. That's
50J and 51.
yeah.
Oh, yeah.
And then what Bruce Fort was talking about was further separately decoupling from the Section 250 deduction, which was a mechanism at the federal level to reduce the federal corporate tax rate on that income. So there's an effort globally to establish this global minimum tax, and this law was sort of the United States attempt at this. And so the general idea was to tax this income from other countries at a minimum amount, something somewhere between 10 and 15%. But the federal corporate income tax rate is much higher than that, in the 30s. And so what the 250 deduction was, it just cut out half of the income so that it accomplishes the same thing. If you have this much income, this tax rate, so it just cut out the amount of income subject to the 30% federal corporate tax rate to try to get at like a 10 to 15% tax rate federally. Of course, we don't conform to federal tax rates. So pulling in the 250 was just something that came in with our conformity, not a sort of intentional policy decision. And so what Mr. Ford was saying is, if you just do away with that Section 250 deduction that is there for federal purposes, and then offer the factor relief for all that income coming in, which we do right now anyway. That was his point. So that's really two different things: conforming to the new changes in 2025, and then the 250 removing that halving of the income that is really a mechanism at the federal level.
I think it goes along with what Charlie said. The Massachusetts governor and her actions, how does that affect Vermont? Maybe you were just explaining that. Because it seemed to me that her actions will in some way affect perhaps our tax issues here.
I don't, other than sort of geographic proximity, and there are companies that are operating in New England, in Vermont and Massachusetts, that could be. I think her motivation for that is to encourage the tech and innovation sectors in Massachusetts, those businesses that are located in Massachusetts. And so, conforming to these provisions at the federal level assist those in-state Massachusetts businesses.
Keep them there.
Yeah, sure. Keep them there, encourage innovation. If that company operates, has an opportunity to expand in Texas or Massachusetts, maybe it would expand in Massachusetts, and not, those sort of considerations.
But it really won't have an effect on Vermont.
Yeah, I'm not sure that it would have an effect on Vermont if Massachusetts had that conformity. It would for those Vermont businesses that are engaged in similar activities.
Right, and that's kind of what comes up for me is, the likelihood that regional companies are paying taxes in both our states, just adds more variations. There's the way we do it for the feds, the way we do it for Massachusetts, the way we do it from Vermont.
I have one other question. Maybe this has to do with Mr. Hackett with the foreign deductions. I did see something about breweries, and I was thinking about agriculture, a logging industry. We send a lot of logs in Canada. We also, purchase grains from there and import it. Is that, maybe this Mr. Hackett will address this, but will that affect the costs of those products maybe coming to the US? I know about tariffs. Probably just add to it.
Will or Rebecca, do you want to speak to that while you're there?
I suppose, as Mr. Ford mentioned, the larger the business, more multinational the business, they tend just to pay more of this nifty tax. So I suppose if it's a large business that is providing these kind of business inputs to Vermont businesses, then they're shouldered with that, additional tax. I guess all else equal, that tax is an additional business expense to that large company. And so it's possible that the prices will be higher for those smaller, probably smaller Vermont businesses buying those inputs from those larger businesses, but that's, you know, the NECD treatment is but one of so many considerations for price for those business inputs.
Do you, any other lines you want to talk about?
Well, I will say that I made these two red because in our, internal discussions about, how we would roll with various, legislative decisions this session, those really jumped out at me and us as like, wow, that would be, almost unadministrable, bordering on unadministrable. I think there's probably a gradation like below that too, that I don't have as much detail to speak to. I did promise Will that I was going to pause and ask him to chime in at various points, and I never did that. So if this is an opportunity that you wanted to add anything, please do. I think my just big takeaway is, and Will said it and said it beautifully, that, changes that lead to small adjustments across many taxpayers are like exactly why we love conformity. So that's it.
I would also add that the question about the qualified small business stock, it's an interesting consideration from a policy perspective on that, because a lot of these changes, what we're talking about is their federal taxable income. So if it's a large business, that is their federal taxable income everywhere. And then the state sort of manipulate it and tax their apportioned share of it. This qualified small business stock exclusion is a benefit to that typically individual taxpayer who invests in a business. So, entrepreneur, founder, investor type, that generally that is going to be taxed at the domicile of the taxpayer. So when we think about that, there's one consideration about Vermont businesses that might qualify for investors as a qualified small business stock investment, but those investors could live all over the place. They could live in California, Florida, New York. And so they'll get the benefit federally, of course, but whether you get the benefit at the state level will depend on the state in which they live. So, if we link up to that, the benefit would accrue to the capital gain for Vermont tax purposes. So generally speaking, that is going to be Vermonters who invest in these companies, no matter where the company is. And there could be exceptions, and please, anyone can correct me if I'm wrong, but generally speaking, that capital gain is going to be taxed to the domicile. So it matters less where the business is. It matters where the person lives. And so if we decouple from that, the capital gain would be taxed in Vermont, would be those people living in Vermont investing in these businesses, no matter where they live, no matter where the business is located. Some of them, of course, are probably Vermonters investing in Vermont businesses. Some of them are Vermonters investing in businesses that are located in other states. They would get the benefit if we linked up to the exclusion. If it's a Vermont startup and there was an investor who lived in another state, it wouldn't matter whether we linked up or not. For state capital gain purposes, it would matter in the state where they live. So there's considerations here. Do we want to, we of course want to encourage businesses to locate in Vermont, but for this particular issue, the issue is on Vermonters who make these investments. And so that's what that should be the consideration here.
Thank you.
We often don't think about, or, I think meet with skepticism, weighing down too heavily on if someone would move because of tax consequences, but there was pretty direct guidance for what an investor should do as an exit strategy from a situation if you have these type of qualified small business stock exclusions, and this was it was not from Gallagher, it was from another organization that was like, providing some guidance for these investors. And, they're talking about, well, start planning 24, 12 months in advance of your exit strategy, make sure you're domiciled in the right state to do it, which was pretty, shocking for me to see, honestly. Learned a lot through this.
Yeah, you see it more in California, if you've got an investment and you've got a huge gain coming and you live in California, moving to Florida in the year that you realize that you exit the business, you realize that gain might help you for state income tax. Federal is what it is, but moving to Florida in the year or years around, making that exiting that business is that's kind of a no-brainer there. We've talked about those kind of issues before.
I think it's we are of course like very focused on state taxes because that's what we all do. But state taxes are such a teeny tiny portion of a business or an individual's total tax responsibility that it's has to be quite an extreme situation to change someone's behavior.
I mean, this policy is extreme, for designed for extreme situations.
Yeah, absolutely.
$3 million difference between, California and Florida, for example.
Yeah. Anything else you all want to add?
Really appreciate the time.
Yeah, thank you. And if you want to unshare, there we go, you did. Cool. Thanks.
Unceremoniously.
Oh, that's what you did unceremoniously, thank you. Next up, we have Joe Livingston from NCSL, who recently published a piece on this topic.
Thank you so much for
Welcome.
having me. I really appreciate being here. I'm also planning on sharing my screen if I have that capability.
Can you just wait 1 second? Thank you. Can we turn up the volume slightly on Joe? And can we lower our table bench volume too? Because Joe's a little hard to hear. Great, thanks. Back to you.
How's the audio coming through now?
It's great, thank you.
Great, wonderful. Let me see if I can share my screen. Okay, that should be coming through if I can get a thumbs up on that.
Yep.
Wonderful. Okay. Let me get one other thing in place and then I will begin. Okay, well, welcome everyone. Thank you so much for allowing me to be here. Just for the record, I'm Joe Livingston. I'm a policy specialist with the National Conference of State Legislatures. And just to remind everyone, I think all of you, many of you have worked directly with our organization, have seen you at Summit, and some of you participate in our state and local tax task force. We are a nonpartisan, bipartisan organization serving all 50 state legislatures. That means that we are always available to all of you members to provide analysis. I think our specialty is really giving you the 50 state landscape of what's going on, which can be hopefully helpful as you seek to make connections and ground what you're doing in the bigger framework of what other states are doing. We don't take an advocacy position and work to try to provide a balanced perspective of what's going on across the states. So a lot of what I'm going to cover has been covered, particularly the beginning of my presentation on some of the HR 1 changes. So I'm going to really breeze through those and then try to get us quickly to looking at what's happening in the other states. So as we talked about, a little bit about HR 1 impacts, we'll talk about the revenue implications and give a few specific examples of those. And then we'll put Vermont in context there. So again, these are the areas I will not go into great detail on. We've discussed in very good detail with folks who are more expert than I am on some of the major changes that are flowing. This will be here for the record. Do try to spell out all my acronyms and everything else. So hopefully this can be some very basic background on these changes on the corporate side. And on the individual side, I know that the focus here today is not on this section, quite a few changes as well. One thing I do want to point out, because we've studied the issue on the individual taxes. I think when HR 1 was initially passed, a lot of the reporting that was coming out, a lot of the media attention said, these are going to be flow through taxes on the individual side, and particularly the tips and overtime and the personal car loan interest, which I also, caveat here has so many restrictions that I'm not sure this is going to be a major deal for anyone. But in fact, these are below the line, very specifically, line 11 is the AGI, and these come at around, I think, line 13 from the Schedule 1. And as the note says there, these below the line taxes may still impact state revenue depending on what the starting point is. And every state uses a different starting point. And not every state uses AGI. States have various amounts of add back. So as we say with everything on these tax impacts, it's very specific and individualized to the state and their policies. The revenue implications for states are often quite significant. Here are a few highlights of what states believe the impacts will be. And again, those impacts are very specific to the degree to which the state conforms to the federal tax code, to the IRC, and how much they have previously decoupled or have chosen to decouple. But in DC, you can see an estimated loss of over 593 million is what they came up with, which prompted an emergency decoupling action last year. In Oregon, they believe, and this may be the heaviest hitter nationally, at least from these estimates, that they could lose up to 900 million. Delaware, 222 million in 26 and another 107 in 27. And, some states, we should preface, have adhered voluntarily to the tips and overtime deductions, which, of course, would have a revenue impact. But those, I don't think we can assign explicitly to HR 1. Example would be Michigan deciding to take to carry the tips and overtime. But because it's below the line, they didn't have to do that. They voluntarily essentially chose to make that a priority. And then, this is from the Vermont. We of course, we were just looking at a different version of it. I think this version might be slightly outdated based on what the previous speakers showed, but it shows that some of the key areas and, the special depreciation being one of the biggest ones, and the full expensing for research. Another example of where we're seeing that significant loss directly tied to Vermont if it should conform and link up to these changes. So then we get into, here's some just basic definitions of conforming and decoupling. I put at the bottom that these deductions and tax policies on conforming and decoupling are very unique per state, and they're often not easily categorizable, but we try to do our best. And this is, what the map looks like in 2025, states with rolling conformity, static conformity as Vermont. And then, the yellow, depending on how you look at it, or golden, however that appears, may need to be larger than it looks just because there are so many nuanced decoupling actions and adherences. But this in a broad scope gives you a sense, a flavor of what the landscape is. Perhaps more interesting right now is what states did in 2025, and it says it includes some of the things, and I'll briefly discuss those in the next slide of what's under discussion right now for 2026. Most states did not do anything in terms of conforming or decoupling. Of course, for some states without an income tax, and that may. Yeah.
What did we do?
I'm sorry.
Oh. Yes. Okay. Thank you.
Yep.
Okay.
Yeah, and so in some cases, we see the green states where there was some type of conformity or decoupling change, and those were made prior to HR 1. So a number of states have sort of looked at their legislative calendar and looked at what was coming down the pike and said, we're going to back up. We're going to put that date earlier in time, and then we'll reevaluate once we actually know what it is we might be adhering to. And then a number of states had either special sessions or were still in session and were able to make changes after HR 1. I think this map will look different in a few months. Go ahead.
Joe, just if you present this map in other states, I just want to offer that the way you have it colored, it looks like Vermont did something very purposeful related to HR1, and we didn't. We actually just every year go through a conversation about conformity.
Sure. No, that's a
Because
good
we
point.
have, we have
We'll do it.
technically have static conformity that functions as if it's rolling conformity.
Yeah.
So I don't know if you
we'll try
like want to make us purple or whatever color you want, but the
Yeah.
green feels like we're explicitly preparing, but we're just sort of always doing that.
Yeah. And that's a good point. You can see Alabama down there, and it did something. Its change was related to a decoupling action related to TCGA that had nothing at all to do with HR1. So yes, we can certainly do a better job of contextualizing whether this was in relation to or not to HR1 or preparation for it. So I appreciate that point.
Thank
And then pull up some additional notes as I talk through this. You know, there were a lot of state actions in 2025, as we just discussed. In many cases, it was holding fixed IRC dates, often to December 31st, 2024. The broad conformity, pausing broad conformity until their fiscal projections could stabilize so that they could kind of do additional analysis. And then where we saw targeted decoupling, most of that was around these areas of research expenses, bonus depreciation, and the earnings before interest, et cetera. Those were the big areas that we saw. You can see a few examples where California, where they updated the conformity, Colorado put QBI as an add back and decoupled from FDDI after it was identified that after they identified the HR1 revenue gap. Delaware limited bonus depreciation, decoupled, and DC had a number of emergency decoupling efforts as we saw their revenue loss was pretty high. Hawaii did the updated conformity. And right now, and we'll look at this a little bit more on the next slide, but I do want to note that in addition, we talked about Massachusetts, there are a number of states that even in the last few weeks, last month, have been actively considering additional efforts. Arizona, their HB 2785, if it moves forward, they want to go toward more alignment, including aligning with the income tax, the overtime and tips compensation similar to Michigan. So voluntarily kind of adding that in, even though it wouldn't automatically flow to the state, creating new deductions for seniors age 65 and older. They wanted that to flow through, as well as several others. In Virginia, they're looking through HB 977 at reverting to fixed date conformity, their date to December 31st, 2024. So essentially not passing through most of the items from HR1. That's still in deliberation. And Oregon is discussing a wide range of measures, particularly given how, at least their fiscal analysis, how dire it looks on their end, the impacts to their state. Most of those would be on the corporate side. And looking at the next slide, just kind of categorizing what different states have done. And you know, again, I hope you're comfortable, but if not, I'm happy to change it on what we do with Vermont with the static conformity dates updated. We tried to put that in just the most factual way of the date was updated, but or this is what we kept. But here you get a kind of flavor of what states have done in each of these categories and where your company might be should you decide to take certain decoupling actions. I'm not going to go through these each individually. You can see that a lot of the actions are around bonus depreciation, which makes sense given that seems to be where a lot of the loss comes from. And then certainly on the research and development side, those are sort of the two big ones. And then when the static states are changing conformity, they're typically changing it to, the beginning of 2025, end of 2024, and then deciding, having these further discussions like you're having about what you want to do with individual provisions. Right. And then on You know, as we saw, most of the revenue loss in Vermont is related not to the individual side. You'd be in very similar company should you move forward with any changes related to research expenses, the 100% bonus, and the additional corporate measures. These are the areas where we're seeing most of the action, which makes sense. I mean, these areas, I think there's been reticence by states to, except for a few, Michigan and Arizona so far, to adopt the individual measures if they don't need to, because they don't immediately flow through. I think we're seeing many states sort of take a, well, we're going to not do anything here action. And that way they don't have to get into the politics of, you know, aligning or not aligning from HR1 directly. But in some cases, depending on, you know, on the individual needs and the capacity of state governments, they may look at actions like Michigan and Arizona's potential of voluntarily aligning. So that's kind of the 50 state picture. These slides are available for you. And as always, we are available to support any of you. We are going to continue some of these discussions at our future meetings, including our summit in Chicago. And we are always available for questions, and I'll take any that you have now.
Thanks. Do you want us? Oh, great. Like, do you want to make your face a little bigger? Hi. Any questions from anyone?
Not at the moment.
Okay. I think we have a lot of digesting to do. And might reach out to any of the many witnesses we've had today to ask some more specific questions as we dive into more details. Thank you very much for your time, Joe. Really appreciate it.
Anytime.
I'm sorry I nitpicked your presentation.
No, please. That helps us improve.
Folks, I think maybe it's best that we all just sort of sit with this on our own a little bit and digest, and then we come back to the table to talk about what direction we're all imagining. Okay, great. So then I'm going to end our time together for the day. We're on the floor at 3:30. Please do take a minute to write down notes to yourself before all of our brains move on to whatever the next topic is. Yeah.